Hello friends. Last week in my video, we basically discussed whether the bulls could revive sentiments and what the market statistical data implied. In this week's video, and with a slightly changed format, I want to discuss whether the budget can have any kind of a reviving impact on the market sentiments. So, without much further ado, let's dive right into the market. And on your screen right now is the market roundup window, which tells me that the broader based Nifty gained relatively more than the bank Nifty, and the US dollar index fell lower, which was a welcome sign, which I have been telling you in my past videos. Emerging markets, including India, stand to gain from a weak dollar. The dollar also pushed up bullion, and crude oil jumped even as natural gas fell. On my free Telegram channel, I have given you an outlook for natural gas and updated the same with outlook of natural gas vis-a-vis crude oil, which is a better trade. Do make it a point to check that out. The USD INR, which is the dollar versus the Indian rupee, fell in a tandem with the US dollar index. The 10-year benchmark bond yield fell because bond prices went higher, which was one of the reasons why the Bank Nifty rose. MWPL continued to rise, which is along expected lines. The US headline indices rose on a week-on-week basis, and that provided tailwinds to our Indian markets. Do remember, in the last few weeks, I have been telling you that the Dow Jones Industrial Average has indicated a golden cross, which means the 50-day moving average has crossed the 200-day moving average upwards, and that usually has bullish implications. On your screen right now is the MWPL, the risk appetite of two marshmallow traders, which has risen on a week-on-week basis, although marginally lower than it did after the expiry of the November series in relative comparison. So, not a surprise, the markets haven't really been very gung-ho, which is why risk appetite tends to be curtailed. The stock and index futures turnover show a small uptick on a week-on-week basis, which tells you that the declines that occurred in the markets were on a somewhat higher participation. Now, this data is something I have been updating on my social media accounts daily. The advanced decline ratio, which is an average of all the 5 trading sessions of a week, has seen a pickup, which is healthy because ideally speaking, we would want the advanced decline ratio to stay above 1 along with rising prices to indicate any sustainable upthrust. So, will it continue? Let's wait and watch. This is again another metric I update on my social media accounts. Now, the basis is nothing but the premium or discount seen on the futures vis-a-vis the spot. Basis has contracted. 2 reasons: selling at higher levels, which is why the futures lost a great deal of premium over spot, and the time remaining to expiry. Just like options premium, futures basis also tends to contract over time. The impetus chart shows an upthrust across both the indices, which is a welcome sign. This is our exclusive in-house indicator you will not find anywhere on the internet. The fact that the impetus has risen on a week-on-week basis when the indices have risen tells you that momentum was relatively stronger on the upthrust. Now, that shows that the bulls are willing to take some amount of risk and push markets higher. So, this is the first green flag or a positive indicator of the week. The LWTD, another indicator that I have started sharing with you with a little over 3 quarters ago, tells you that the buying support on declines is likely to remain flat as compared to the week gone by, which means even though The advanced decline ratio has risen a little. Buying support at lower levels is not likely to be of a huge magnitude as much as I would want it to. So, this is somewhat of a mild concern, but it can always change. Now, this is another metric which I update on my social media accounts every day. If you care to connect with me, I will update this on an end of the day basis. Let's now go to the bond market, which tells you that bond yields have fallen on a week on week basis, as you can see on the weekly chart on your screen, which means bond prices have gone up. Now, that is a relief for the banking space, which is why the Bank Nifty has risen on a week on week basis. And which is why I have been telling you to hold on to your checks, which you are willing to wait and write in the fixed income space. I am basically looking for a crossover above the 7.50 level, and remain assured, my word stands that I will put up an update on my Telegram channel as and when that event occurs. Moving now to the Bank Nifty. What you are seeing is that the Bank Nifty, after clocking gains of 0.43%, having rallied on 3 out of 5 trading sessions, what is noteworthy are two aspects. Number one, the 41,840 swing high level of September is proving to be a rough and ready support. The Bank Nifty is meandering around that level and consolidating. It's not falling below that. And the other aspect is that the price is below its 25-day exponential moving average. I have recorded a short video as to why the 20-period moving average is the most reliable one across the board, loosely fitting across the board. Then why am I mentioning the 25-period exponential moving average for the Bank Nifty? Hey, that also depends on the volatility or the statistical beta of the underlying counter. You could use a 20-day moving average for the Nifty, but the Bank Nifty is relatively speaking more volatile, and therefore the tweak in the moving average. The 25-day exponential moving average of the Bank Nifty is pointing downwards, and the price is below that average. It needs to break out. That would be the first thing that I would want to be met before calling out for an upthrust on the Bank Nifty. Moving on to the weekly chart, what we are seeing, a long leg doji, and that too an inside formation doji. The body of the long leg, a very narrow bodied doji, is contained within the previous week's bearish doji, which tells you that there was indecision, a lack of clear dominance by any party in the market last week. The price remains above its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. So the medium-term outlook remains positive for now. This is mean reversion in play, which means either the price moves towards the moving average downwards, or the moving average catches up with the price, which is going sideways. Unless and until the price falls below the 25-week exponential moving average, the medium-term outlook does not get weaker. Friends, in the week before last, this index was at number 5 on the most volatile list of the statistical beta counters that we maintain in-house. It rallied one notch to go to number 4, which is not great because volatility rising makes it a bigger challenge for a retail trader. Now, last week I advocated a range between 43,600 on the upside and 40,775 on the downside, which held perfectly well. In the coming week, I expect a range between 43,750 on the upside and 40,975 on the downside. I continue to maintain that my friends should be trading on smaller trade bet size. Friends, I now move to the Nifty 50, which gained 0.54% on a week-on-week basis, and it notched gains on 2 out of 5 trading sessions, as you can see on the daily chart on your screen. Here again, the price remains below its moving average, this time the 20-day moving average. Do note, I mentioned why 20 and 25 days am I taking. So the price has remained below its 20-day moving average, which is a month-long holding on cost of an average bull. And it's also remaining below the swing high that was logged in March 2022 at the 18,115 levels. We need to break out above this level, which incidentally is something where the 20-day moving average is also placed. So we need to break out above this level on a sustained closing basis before the bulls can start capturing the dominant portion of the market fence again. Going on to the weekly chart, we are witnessing a long leg doji, and that too contained within the prior week's bearish candle, exactly like the Bank Nifty. The chart is mirroring the Bank Nifty's weekly chart with one prime difference. The Nifty's price is within a kissing distance of its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. Mean reversion, like I told you last week, has ended. If the price falls below this moving average, it could mean some amount of trouble for the Nifty bulls. So far, so good. Let's wait and watch if 18,115 hurdle is cleared or not. In the week before last, this index was number 10 of statistical beta list of highest volatile counters. It fell one notch to number 11, which is a welcome sign. The lower the volatility, the lesser the challenge for a retail trader. Last week, I advocated a range between 18,350 on the upside and 17,375 on the downside, which held perfectly well. In the coming week, I expect a range between 18,450 on the upside and 17,475 on the downside. I promised you in the beginning of this video that I will discuss whether the budget has any kind of an impact on market sentiments. Now here goes. Normally, the budget is an exercise before which traders try to second guess as to what the announcements in the budget will be, and then they try to place their bets in the market accordingly. This time around, what I am seeing is a lot of hypotheses being put forward in the media that the budget is likely to be focused on PSU disinvestment. Do note one thing. This is the final 2023 budget is the final budget to be presented by this government before the election year of 2024, when, as per Election Commission rules, the 2024 budget will be a limited budget, wherein the government will only pass the necessary skeletal expenses required to maintain running of the government. That is as per the rule. So 2023 budget is the final budget where big ticket reforms might be announced, which makes the budget all the more important. And all this talk about PSU disinvestment and unlocking of shareholder value, which is the government's own stake in these PSUs, is one big thing. And am I trying to tell you to depend on hearsay? Certainly not. Those of you who know me know that I will go by statistics. What am I seeing in the statistics? That the usual suspects, the PSUs, are witnessing a lot of energy by way of rising MWPL, by way of rising participation in the volumes, by higher TSTs, which is ticket size per trade per transaction, which is something that we specialize in. All the breakup of all those statistical inputs is something that we monitor on your behalf. So what I'm seeing by keeping my ears to the ground and listening to what the statistics are telling me is that a lot of hope-based buying is taking place in the market. Will it have an impact on the prices? I think it will. But what will happen is also that volatility is going up. The bid and offer spreads are widening because it is the retail that's doing most of the buying. Now, the special segment that I've started since the last few weeks, what will I do in the week ahead? Firstly, I will trade extremely light. I know I'm a light trader. I've been cautioning you against taking very heavy positions off late, but I will trade even more lighter because what I'm seeing is that ingress and egress, which is order fill on the entry side of your order, and egress, which is exit side of your order, squaring up of the order, both are getting very labored. You're neither getting an entry or an exit at the price that you want, and that too at the snap of a finger. The markets are making you wait. That means sporadic price behavior. Markets appear a little edgy, appear a little nervous. This is not a market where you bet the farm, bet your house, and bet the bank. So let's be careful out there. Number two, spreads are widening. Never a good thing. When bid and offer spreads are widening, my take home profits are lower because I'm paying the market maker a wider spread and I'm enriching the guy at my own expense. So, there again, another reason to trade light. I will continue to bet on theta decay and I will also want the market to settle down after the good results announced by HDFC Bank. I've written long editorials on on our free Telegram channel about interest rate sensitives, about banks. I don't think it's time to change any of that view just because HDFC Bank has announced good results or results that some people may or may not like. So the view remains, do check out that. And I would want the market to settle down after the results are digested by a large segment of the market and market price discovery begins all over again. Now, friends, for the most popular segment of the market, for the statistically inclined, wherein I share 5 stocks which have gained the most amount of impetus on Friday. So you take small exposure, wait for large price moves on Monday, and 5 stocks which have lost the most amount of impetus on Friday. So you take big exposure, wait for small price moves. This is for scalpers. If you want to be updated with this list Tuesday through Friday, please do subscribe to our free Telegram channel when I update this list every day free of cost, along with a whole lot of other statistical, simple yet highly accurate, exclusive in-house indicators and tools you will not find anywhere on the internet. We don't charge any subscription fees. So do connect with us. Now here goes the list of statistically high impetus gainers is led by Adani Enterprises, followed by Bharti Airtel and Tata Motors, Laurus Labs and Ultratech Cement. Impetus losers, wherein you take big exposure, wait for small price moves, is led by IDFC, followed by Manappuram Finance, REC, Rural Electrification Corporation, followed by Canfin Homes and Power Finance Corporation. Friends, I hope this video of mine helps you trade much better. I would love to hear from you in the comment segment about how our work is adding value to your trading experience. Before I wind up this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here and help me reach out to a wider audience of smart traders like yourself by sharing my video with your family and friends. Thank you for your patience till we meet again in my next. This is Vijay Bambwani signing off for now. Have a very profitable week ahead. Bye-bye.